It doesn't change my view that Bitcoin is not at a bottom yet. Bitcoin in its normal bear market cycles goes down about 80 to 85%. I think it's only down about 70%. And this is the first bear cycle the Federal Reserve has not been printing money during it. I mean, with the volatility in the stock market, there's been some great plays. You know, the markets had gotten crushed from June through July into early August. Then we saw the stock market stage a massive rally up, then a big fall just in the last couple of weeks before this latest bounce. So I would say in stocks, it's been tremendously good in terms of swing trading and day trading and kind of positioning yourself. And then I also think, you know, gold is starting to look very interesting down here. It's looking like it's trying to hold support. And I think the biggest thing out there that investors should be paying attention to is the dollar and then the 10-year yield. And those both have been on a tear lately, although it does look like the dollar may have topped. So short term, we probably have a near-term top in the dollar. It doesn't necessarily mean we can't go higher in a few months, but there were some key things that actually happened here. And I'm going to bring up and I'm going to show this chart for you guys. This is a line that I was following recently, and you saw the yen was just getting crushed against the dollar more and more. But look at the trend line that we just hit a couple days ago. And that to me was a signal that the dollar may start to weaken. And sure enough, we've started to see that. We should see a continued pullback on the dollar yen all the way back to at least 139. So there should be some more downside. That does imply that the dollar, the DXY, should also stay weaker in the near term. Like, so much of this market has been driven by the strength in the dollar. And what I mean by that is, as the dollar was going higher, stocks and risk assets were getting crushed. We even saw gold getting crushed, right? So the fact that the dollar near term has topped, it should give the stock market, crypto, a little bit of a reprieve to maybe have a small bounce higher. So definitely we're looking at that headline and core number on the CPI data, so the consumer price index, which basically is what the market's paying attention to so closely, because it's what the Federal Reserve will likely gauge their next rate decision on, right? So if you still see very high inflation and it's not coming down, it's likely going to signal the Fed has to do 75 basis points at the next meeting. It should be trickling through to the consumer price index, which means inflation should show that it is kind of fading a little bit. Now, I think the kicker is going to be this, is that I don't think we're going back to that 2% or under that the Fed really wants us to get to for years. And I think that's going to be a big issue down the line, as they're not going to be able to stimulate if we go into a recession. So if you think about it, every recession we've had for the last 20 years, basically, the Fed has stimulated in some way, whether it's printing of money or dropping interest rates or buying bonds to have on their balance sheet. They've been doing massive stimulus. That was all with 2% or less inflation. The fact is, we're at a point where unless they get that below 2%, they can't print money again to save us from the next recession. And that's the boogeyman to me. That's the real scary thing. If this economy goes into recession, how do we get out without the Fed's help? Yeah, I'm kind of right in that 4%-ish area, give or take a little bit. And I think that's going to be elevated enough that it's going to make it very hard for the Fed to stimulate in the next recession. And that's again, really a tricky scenario, because I feel like the markets are so conditioned to say, oh, well, you know, if we go into a recession, no big deal. The Fed will print some money and we'll get out of it in 6 months or whatever it may be. But they can't do that, because what'll happen is you'll see inflation surge back, this time maybe higher than 10%, maybe 15%. And again, that's going to keep them on the sidelines. And the market's like a child that kind of doesn't have their parents standing by to protect them anymore. The market is going to have to figure it out on its own, and it probably won't be super fun. I found that so fascinating, right? And so let's rewind even more to Jackson Hole. So Jackson Hole, he came out extremely hawkish, like the most hawkish I think we'd ever heard him speak. And the markets freaked out, and we saw a big sell-off that day, and really the following 1 week period was a massive sell-off in the stock market. But if you look at the underlying factors, the market, the bond market, which is actually the smarter of markets, it's the market that has more money, it has more big money. So people think about it as being the smarter of the markets when you compare the stock market to the bond market. The bond market did not believe him, right? So let me bring up this chart. And if you look at, this is the daily chart. And over here, this was in June. So in June, the 10-year yield was at 3.5%. When the comments for Jackson Hole came out, we were at 3.1, and we've only gone back to 3.3, even with the most hawkish comments the Fed has ever put out on hiking rates and being just hard against inflation. And what that tells me is that they believed that rates were going to go higher back here than over here. And so basically the bond market is calling the bluff from Jerome Powell and saying, you know what? We think you're talking a tough game, but we think that when the economy starts to weaken, you're going to back off really quickly, and we're not going to see rates as high as what the stock market is thinking in this situation. So I'm in the camp that I think it all depends on the CPI data next week, whether it's 50 or 75. But I do think if the inflation comes down decently, we might only see 50 basis points in the September meeting. Yeah, and I think the main reason for that, and a lot of people are confused, is that coming off of the pandemic, there's some really weird dynamics going on. So it's a little bit different versus the GDP of a normal cycle versus what we did see. So I understand why people are kind of like not willing to call that a recession. Now, having said that, I do think that if you see another quarter of negative GDP, then absolutely you have to call that a recession. And I also think if you start to see the jobs numbers decline into negative territory where we're actually losing jobs numbers, then you also have to say, okay, at this point, we think that we're in a recession at this point. But very weird time right now coming off of COVID. Yeah. So again, when oil was trading, I think even in our last discussion, I said I was generally bearish on oil, even though everyone was saying, oh, it's $115, $120 a barrel. It's going to go to 150 to 200. And the key is this, is that everyone's thought process for why it was going to spike was that Russia's oil wasn't going to be bought and put on the market. So you had this reduction in oil, big reduction in oil that was on the open market. And the reality of it is I clearly knew from past experiences with Iran that they just sell their oil at a discount to China, to India, to other countries, and other countries are more than willing to take that oil. So you weren't really removing oil off of the open market. In addition, the Federal Reserve tightening, the ECB is tightening, everyone's tightening interest rates. What does that do to the economy? It slows the economy down. See, we actually did recently just hit this trend line, which again, you're seeing a bounce today. We're back to about $86.77. But I think this is just a bounce before we break this line. And I think you're headed into the mid 70s by year end. So I still think there's more downside. And again, it's going to coincide with seeing the economy in the US continue to signal recession potentially. And I think Europe's going that direction, maybe even worse than the US because of the natural gas crisis. And I think most of the world, I think China's already kind of there already due to what I'm hearing as well. And this is a really cool point about gold, is gold has still been an amazing performer this year. Number one, if you looked at gold in terms of euros, it's having a great year. If you looked at it in terms of yen, it's having an awesome year. In terms of the dollar, not so great. But even then, the dollar's rallied 15% this year, and gold is only down about 4 or 5% for the year. So think about that. In a normal market, if someone told me the dollar was going to be up 15%, I would be like, okay, well, gold should be down 15% then. The fact that it's only down 4 to 5% tells you that it's actually doing its job and holding on to its value very, very well, especially when you compare it to the S&P or Bitcoin or anything else. Yeah, so Bitcoin's been dancing right around that 20,000 level. And the reason why I was harping on 20,000 is because that happened to be the high from the last bull cycle. So in 2017, we saw this unbelievable percentage move to 20,000, and then the bear market started. Finally, we got into the next bull market. And then basically when price came down there, you would expect it to have some bounce and some sideways chop. And that's exactly what we've seen here. It doesn't change my view that Bitcoin is not at a bottom yet. Bitcoin in its normal bear market cycles goes down about 80 to 85%. I think it's only down about 70%. And this is the first bear cycle the Federal Reserve has not been printing money during it, right? So in every past bear market cycle, the Fed's been printing money with QE and QE1, QE2, and all those. And this is this first cycle, it isn't printing money. And that makes me wonder if at least we go down 80 to 85%, which gives me that 12 to 13,000 target, or could we actually go even a little bit lower? So I think that we're still going to see another leg down, minimum 12 to 13,000, and then I'll have to reevaluate if it's going to go lower after that. Yeah, so I think that is a very important aspect about reducing energy, because I know that a lot of fund managers and investment portfolio managers, one of the things that they're always pressured on is being very environmentally conscious, right? So that's going to alleviate that issue. And then also the merge is going to change the way the mining is done, which almost creates it as a deflationary asset, almost like kind of a Bitcoin. So I actually think longer term, this is really bullish for Ethereum. And I do think that it makes it much more attractive to investors overall, not just for the utility purposes, but also for the savings and kind of a different way to invest versus holding US dollars and other currencies, fiat currencies. So I think that's very good. I think the biggest thing next week with the merge is it has to go smoothly, right? So, and this is big for the entire crypto market. Everyone's looking to that. They need to nail it to give the confidence to the crypto markets. If they do, I think you could get a little short-term upside, kind of the relief of, okay, it happened, it went smoothly. It doesn't change the fact that I think eventually Bitcoin's going to 12, 13,000, but in the near term, it should be a positive. Yeah. So, I mean, I think at this point, the rally we had from even 2009 when the Fed began printing money was so vertical that it pulled forward a lot of the upside in the market, very much like you saw happen in China about 10, 12 years ago, Brazil 10, 12 years ago. And what's interesting about those markets is they've been chopping sideways for 10 years, actually more than 10 years. So if we go to the monthly chart on the S&P, this was the 90 run, the pullback, the 2000 up to 2007, the pullback. And then this is where the Fed started printing money. And look at that. That is not a natural market move. Now, what's interesting here is if we go to something like the EWZ, which is the Brazil ETF, look at this move on the Brazil ETF. And then again, go back to, put that trend line in, let me erase that. And then go back to the SPX again and look at that same move. It's almost identical, right? The vertical nature. And if you look at the EWZ, which is the Brazil market, the ETF for the Brazil, what did it do after that? It topped out after this ridiculous run, big correction, upside, downside, upside. And basically it's been chopping sideways now since the high in 2008. The question is, well, where do you invest? Well, the two charts I just showed you, to me, you don't want to obviously overinvest. But if I had to choose right now, US market be long or China slash Brazil and some of those countries, the South American countries, I would absolutely be going towards those for the next bull move.